Hello, everyone. Welcome back to the channel. This is Fair Value Finder, and yesterday Pfizer came out with their earnings for Q2. So we're going to take a look at the continued decline of this company and figure out, is the bottom in sight or what is going on with the fundamentals. So we see that they are just on a continued decline. We took a look at them a little while back, and my video was titled, "Why is Pfizer down so much?" And it is my most popular video. Actually, as of today, it hit 1,000 views. So it's the first video to hit 1,000 views. Thank you guys for all of that. And it's a company that I've held in the past and I am interested in. So I'm really looking forward to diving in here. We see that it's down to a little shy of 35.5 after the earnings. And if we want to get into the technicals of this, I mean, it's got a pretty good downtrend shaping up. It looks like it's staying on that support right around the 35.5 level. If it breaks down below, there seems to be a bit of support right around the $30 mark, but usually when it's in this range, it moves pretty quickly. But we can get into the numbers and see what exactly is going on there. So here we got the numbers like usual. I have the year-to-date off the earnings reports and the 2023 expectations. And this is one where we are definitely going to be lowering our expectations for this company because they're only at 46% of their goal. And that is actually not even what analysts are expecting from them anymore. I'm going to go even lower than analysts. There might be some analysts that are more bullish on the company, but I'm going to say instead of 67.9, we'd be pretty lucky to see a 66 here. And that's going to knock down a lot of these numbers because these are all calculated based off of that top line revenue. They have decent margins right now. And it all trickles down to an earnings per share where we were looking at $3.35. That extra 5 cents is not looking like it's going to make it. They've only made 41% of that so far. So we're just going to say $3.30 for this year. And of course, if we're dropping this year, we should be looking at dropping next year's as well. So we'd be bringing down the revenue to more in line with what we were looking at this year, 67.65. And the earnings, we're going to drop down to $3.41. It was previously $3.50. So that's how things shape up there. How does that affect the value of the company? It's still undervalued at today's prices. We're looking at somewhere in the mid 40s for both this year and next year. So it's a slow growth year. If that's the new trend for the company, that's not good news. We already see this dividend of this stock only moving 1 cent per quarter. So they've only been raising it 3% over these last few years on a compounding basis. We did see the huge COVID boom. 2021 and 2022 were great. And then it looks like this year is awful compared to those numbers. But if we look all the way back to 2020, before COVID, they were doing 41.9. So 66 is still pretty good. And we can open up the trends and see they're on a decent trend. They went above trend for a little bit. There's not a whole lot of growth built into 2024 after 2023, but it is an upward slope. And the cost of goods is kind of all over the place. They're pretty low on cost of goods this year. Like I said, they have very high margins this year so far. There's not a great trend here. We see dipping up in almost all of these graphs. So the gross profit, net profit, and EBITDA are all staying pretty consistently related, but the numbers aren't telling too much of a story here. The balance sheet, we see some nice asset growth. Tangible assets have trended to the positive side, which is very nice to see. And liabilities, very flat. That's great to see. With the tangible assets trending positive and the liabilities remaining flat, we see the tangible book value trending towards a positive direction. So that is something great. Cash flows, we kind of see 2020 and 2019 are in one region, 21 and 22 in one, and 23, 24. So there's not too much of a story here. I guess there's a bit of growth across these four, and 2021 and 2022 are the outliers yet again. But it's not huge growth year over year in the free cash flows. Dividends, they did cut their dividend back in 2020. They're back above where they were pre-cut, and they're a decent dividend grower. They have grown it more recently only 1 cent per quarter. So we'll see if that's something that they continue with while they see how things shape up, or if they're going to start raising it quicker. And now all of the valuations. So everything's clustered pretty well together. So this is one of the stock where no matter the metric that you're looking at, I mean, we're looking at something in the $50 range, 50s to 60s, a little bit dipping into the 40s, a little into the 60s. But for the most part, you'd be getting a pretty fair value to be buying this in the 50s. Based on this year's numbers, next year's numbers, it looks like it'd be an even better deal to pick it up in the 50s. So 35, 34, I'm feeling is a pretty good price for this. We do see that this is led by the cash flows, which have been trending down since 2021. And it is followed by the earnings in 2022. More recently, the earnings have been at the back of the pack. The fair value that we calculate is actually right here. So it's pretty well in the middle across all of these. So it's a pretty consistent company. The balance sheet, we've seen some decent growth coming off that with that nice asset growth and those flat liabilities. And then the actual share price. So the share price here, we were looking at something in the 40s for a decent value. They were 37, and they hit their peak along with most of these numbers in 2021 at 57. And then they dropped down, and it definitely feels like it was an overcorrection. Because if we look at it, it was consistently one of the middle values, and now it's dropped down to a very low bottom value. And we'd have to dig deeper into the outlook of the company. What drugs do they have that patents are running up? What do they currently have in testing? But if nothing else were to change, it'd be at a pretty good value right now. Now, let me know if you want me to do a quantitative analysis for this. This is strictly a fundamental analysis to see if it's even worth our time and if there's some sort of margin of safety for us as the investor. And it looks like there is. Revenue, we talked about how it's back above where it was in 2020. That looks like some pretty good growth there. Expenses as a percentage of revenue, this one is kind of all over the place. They were in the mid 70s, dipped down to the low 60s, and now they're back to the mid 70s. So we'll see as the year progresses how that shapes up. But if they are able to come in with something along the lines of last year, we'd be looking at a pretty good number there. Earnings per share, they haven't been growing too incredibly strong. I mean, we see almost 25% compounding because they started out in 2019 at $2.88 and they ended 2022 at $5.53. So ending on a high year for those calculations kind of skews it a little bit. They did dip down in 2020. We're looking at earnings this year and next year more in line with what we saw in 2021. Slightly lower. So clearly the growth is not all the way there, but it is in line with that. And at least at that time, that's when the stock was trading in the mid 50s. The share count, they are a company who has been growing their shares more recently. They were buying them back in 2019, and then they sold some in 2021, and then they sold a bit more in 2022, and they have sold even more in 2023. So that is a trend that we would like to see end. Um, there was a lot of hype around pharmaceutical companies, especially with them being one of the companies that came out with the vaccine. So I don't necessarily blame them for using that as an opportunity to bring in more cash. Hopefully, they're able to use that cash wisely and reward investors in the long term. Free cash flow yield, great number here in the 20s. So I love the free cash flow yield, and this is something that's growing quickly too. It's been growing at about a 10% compounding rate. So that is something we'd like to see continue. Tangible book value, we talked about how it did trend to be positive. If they do come in on trend with other metrics, this might dip negative again. We do see that they had a really good year in 2021. 2022 was going back down. So based on how things have gone, typically they might be dipping back into the negative this year. If they don't, that would be great, but it looks like they might. Debt to equity, they are a little heavy on debt. I mean, we don't want anything over a 1, but they've been making great strides to cut this number down, going from 1.65 to 1.44, 1.35, 1.06. So I would not be surprised if it goes down below 1 here in the near future, and we'll be looking forward to that. So some of these things I'd want to be buying in before they happen. Like before they start buying back shares and before the debt to equity goes below 1. The trend shows that it's going to happen here pretty soon. The price looks pretty good. So I'm really leaning towards this going on the buy list. And then finally, the ROE. Clearly, the debt is a little high with the debt to equity ratio that we see. We want to see an ROE above 20. We see last year they came in just shy of 33%, and they've come in above 20 3 of the 4 years where we have that calculation. So they've proven that they're capable of it, and things look good there. So looking at all this, I'm definitely leaning towards a buy on this stock. I do want to do a quantitative analysis on it though. So this is not the whole story, and we'll see how things are going to be shaping up here into the future. But I want to thank you guys for watching. Please like if you enjoyed the video. Comment if there's any other stock earnings that you want me to take a look at. And subscribe so you can stay up to date on everything. And I'll catch you next time.